Get things formally underway. So, hello everybody, welcome. I'm Terry Ryder, founder of hotspotting.com.au. Welcome to today's special webinar event, and this one is particularly special, I think, because the subject is catching the next wave of property growth, because that wave is very much upon us. In fact, starting to feel a bit like a tsunami crashing over Australia. We're undoubtedly in the midst of a nationwide property boom. The latest price data was out this week from CoreLogic, and it shows that every major market jurisdiction in the nation had growth in their property prices in February. Now, some of you may not realise how significant that is. It's the first time in over 15 years that all markets across the nation have risen strongly all at the one time. Genuine national property booms are extremely rare in Australia. The last one was in 2001, 2002, 2003. So it's almost 20 years ago, but we're definitely in the middle of one right now. And to explain what this all means and to discuss what every investor needs to know, our special guest presenter is award-winning buyer's agent Rich Harvey, the CEO of Propertybuyer.com.au. Rich, welcome.
Thank you so much for having us on again, Terry, and it's always a pleasure to share the stage with you. And you've got some great research that we rely upon, and yeah, great to be with all your viewers as well.
Okay. Well, over to you. I know you've got some slides to share with us as you talk through your assessment of what's going on with property markets at the moment. And just to remind people, we're going to allow plenty of time in today's 1 hour space for your questions. And if you do have questions, please type them into the Q&A panel or the chat box, and we'll get to them as we work through over the next 60 minutes.
Fabulous. Yeah, thanks for saying that, Terry. Look, we would really encourage your questions today. I don't want to bore you with too many slides. I've got some more updated slides on the market. But what I'd love to do today is just you do three things. Actually, just a bit of background about myself firstly. I think Terry did a great introduction, but it's actually my 20th year in business as a buyer's agent this year. So looking forward to celebrating that milestone later in the year. Also contributed in professional ways, being the president of the Buyers Agent Association of Australia for 4 years, and also the chairman of the Buyers Agent chapter for the Real Estate Institute. And I'm also a fully qualified property investment advisor. So today, what I'd like to do is just give a quick market snapshot. And Terry, please pipe in with any of your comments as well with some of these slides. Yeah. And then I'd like to talk about how do you approach this market, because you know it's a really hot market and it's become hot quite quickly. Someone's turned up the gas pretty much to full bore. How do you manage it? Do you sit on the sidelines and kind of watch, or do you sit out, or do you participate? And if so, how do you do that? So we'll look at that. Terry, we'll talk about some locations that you've recommended through your reports, and then I'll just talk about some recent case studies, and then love to throw it open to lots of Q&A at the end. So hope that sounds great, everyone. So where are we at today in the market? Well, I've just got some of the latest figures from CoreLogic from their chart pack, and this is showing the trajectory of property prices. This is the whole of Australia. So basically, they reported yesterday there's been the fastest rise in property prices in 17 years, and that's obviously coming out of the depths of COVID. And you can see the dramatic bounce back here. We were down here in this area here in negative territory, but it certainly didn't get to the 30% negatives. It went to 5, 6, or maybe even 7% in some areas. But we've seen a quick rebound in most areas across Australia. We're also seeing auction clearance rates through the charts. So last weekend, we had 90% in Sydney, 82% in Melbourne, Brisbane 73%, even Adelaide and Canberra in the mid-80s. So very, very strong auction clearance rates right across the board. And we're seeing what I don't want to use this word, but unprecedented. It keeps getting used during COVID, but literally unprecedented numbers of bidders at auction. And I'll tell you a couple of stories about that as we go through.
Those numbers for Brisbane, Rich, Brisbane's not much of an auction city, really.
That's right.
And normally, in normal times, the auction clearance rates tend to be sort of 30 or 40%. If they're up around 75%, something major is happening in Brisbane, and there is. We'll talk about it later.
Well, that's interesting, Terry, because I think obviously Melbourne has always been the auction capital of Australia. Sydney then caught on, but it's now filtering into Brisbane. A lot of the agents are going, you know what, I don't know how to price this property, or I'm going to do the best thing for my vendor, put it to auction and let the market fight it out. I mean, I'll just tell you a quick story, Terry. I went to auction recently for a client to buy a home in St Ives. Now, I thought I had a good chance. Now, the agent was guiding about 1.8, 1.9. It was a place that needed a renovation, did have a lovely bush view over Garigal National Park. And I thought probably around 195, might nudge 2. Turn up on the day, 21 registered bidders. The reserve was set ridiculously low at 1.7. I don't know how they did that. Anyway, it went for 2.22. So 500 over reserve, which was an unrealistic reserve. But I don't normally get it wrong by 200 grand. And that's been a regular occurrence the last couple of weekends at a lot of auctions, Terry, where buyers just come in and throw everything and more at the properties.
And stories like that happening all over the country that I'm hearing, Rich, and it's not just at auction, it's just when properties are just listed on the market by private treaty, often sold within 24 or 48 hours, multiple offers, and achieving well above asking prices or price guides. And I don't think it's a case of agents underquoting prices. It's the market's moving very fast.
That's
very
right.
high.
Exactly. So that's the auction market. Let's move on to, I guess, a couple of predictions. This came out about 2 or 3 weeks ago. This was the Westpac economists putting out their numbers on where they think the property market will grow in the next couple of years. So they're saying that Sydney in 2021 will have a 10% growth rate, and then in 2022, 10% growth. Melbourne, 8 and then 10, Brisbane, 10 and 10, Perth, 10, 12 and 8. So, pretty similar numbers across the board in most capital cities. So the Australian average is 10 plus 10. I actually think, Terry, that's conservative. I think we could possibly, if this momentum keeps up, you could do 15 or 20% this year and a bit lower numbers next year. But it'd be interesting to see.
I was about to say the same thing. I think the word I was going to use in terms of those predictions is conservative. There was one that came out ahead of the Reserve Bank interest rate decision yesterday with a panel of so-called experts saying that they expect property prices will rise about 12% in the next 2 years. Come on, I mean, we're getting that sort of growth in almost in a quarter in some markets.
Yeah,
certainly, yeah. I think, we're going to be probably closer to 15% this year as a national average, and again next year.
Well, interesting, Terry. I had to do my compulsory professional development to renew my real estate license. And one of the questions was there, and this is more for selling agents, is how often should you update your vendor on the selling price estimate? Should it be weekly, monthly, or bi-monthly? And the correct answer is weekly. And it's very, very pertinent, that answer at the moment, because prices are moving on a weekly basis. We're very much in a dynamic market.
I would have thought daily right now, the way things are moving.
Well, maybe that CoreLogic daily index actually has some credence at long last. So,
yeah.
Anyway, well, look, let's move on to the other predictions that we saw earlier. End of last year, Louis Christopher brought out these predictions, and you'll see they bear similar kind of, relatively similar numbers. I think they're, again, quite conservative compared to what is actually going to occur. But these are all his predictions on the basis that the interest rates stay where they are, and that quantitative easing and stimulus measures continue, and actually they were expanded. So this was predicted around early December of last year, and that base case seems like it will be the predictions that he's going to continue forward with. But I think, again, a bit too conservative on those numbers, Terry.
Just one quick illustration of how conservative those forecasts are. Darwin is predicted, and Louis always has a range of scenarios, making certain assumptions. That the assumptions for Darwin may be up to 9%. The figures out from CoreLogic this week show that Darwin's now rising at an annual rate of 16.5%. It's actually leading the nation in annual price growth at the moment.
That's it. There you go. All right, so that's enough of predictions. I guess the other thing is listing levels. Everyone's talking about lack of stock, lack of listings. And what's interesting is that this is the graph for new listings, not total listings. I've got 2 charts here. This is new listings coming on the market in the last 28 days. And you can see the orange line here was 2020, and this black line here is the new year just starting. So we're following a similar trajectory to 2020, which is still way below the long-term 5-year average. And certain pockets of Sydney, I've noticed particularly, have always trended down over time. Like Northern Beaches is down 40% on average in terms of volume of listings. And that just has a dramatic impact on demand. Similar story if we look at the rolling count for total listings as well. We can see here that the numbers are well down again on their long-term average. So what does that mean? Sorry, Terry?
The figures out today, in fact, from SQM research show that there is actually a substantial rise in the level of new listings in February, but the total of overall listings still fell, which is because the demand is still much higher than the supply. Even though the number of listings is rising, the actual supply of properties for sale is still dropping because there are more buyers than sellers.
That's it. So it's and it makes it tough. There's what they say, slim pickings, and that's the reason why.
Yeah.
All right. I guess we'll just move, Terry, to a couple of the trends, and we've talked about this in a couple of previous webinars. What are the trends that we're seeing in the market? So these are what we have certainly noticed is this, exodus to affordable lifestyle, increasing number of first home buyers in the market. One big one we've noticed is expats, particularly coming home, getting settled, and they are going to become an even bigger force in the market this year. Some of them are deciding, should I go back to overseas when the vaccine rolls out? Or, you know what, I've had enough of the overseas lifestyle. Doesn't matter about my excellent pay rate. I'm just going to stay here for Australia because it's safe and it's good lifestyle. So they're going to be an interesting force, and they've replaced a lot of the new migrants that have come into our market over time. The other trend is, or the big one is, I call it feathering of the nest. Huge numbers of buyers want to upgrade their homes or downsize or resize. COVID has really accelerated that trend of improving your nest. So any comments there on other trends, Terry?
The comment I'd like to make, Rich, and the point you make very well with this slide is that the reasons why we have this very strong rising market are complex. There's not just one reason. There are multiple reasons. I've got a list of my factors that are feeding into this in 16 different points. The slide on the screen has 11 or 12 points, because what we're getting from the media every day is that it's all about the level of interest rates, and that's ludicrous. We've had record low interest rates for about 6 or 7 years in this country. Australians didn't suddenly wake up a couple of months ago and realise we have low interest rates, let's rush out and buy property. This has been building through a range of multiple factors, including those that are on the screen right now, for the last, certainly very strongly for the last 6 months. And we've seen sales activity rising up to this point because of all of these factors. The economy is stronger than expected, unemployment's lower than expected. The GDP figures were out just about an hour ago, Rich, showing that in this December quarter alone, the economy grew 3.1%, which would be a good figure if it was an annual figure. So all of that's feeding. You mentioned the expats returning. That's more than compensated for the lack of overseas migrants coming into the country. The numbers of expats coming back actually exceed those normal numbers.
That's right.
So I think there's more coming. We've had, up to this point, strongly rising prices, despite the absence of investors in large numbers. They're starting to come into the market now, and that's going to give it further impetus. And the other big one is the big infrastructure spend that's coming up from state and federal governments, which intend an infrastructure-led economic recovery, and nothing pumps up property markets indirectly like infrastructure spending on a large scale. So I think that's another big factor that we're going to feel as we get through this year and into next year.
Exactly. And the last point I made there, Terry, the investors are back in capitals. We are getting a really strong increase in inquiry from our investor base. Obviously, interest rates are a key factor, and affordability is actually at probably one of its best levels in terms of being able to borrow effectively. I'm not saying it's affordable in terms of pricing, but being able to borrow. And as the people's borrowing capacity expands, that translates into higher demand for housing as people want to upgrade or improve their wealth position. So I think we're also going to see a rental boom coming as well. So I think investors shouldn't hold back. They shouldn't keep their powder dry. It's a time to actually examine where the opportunities are in the market. and start to move forward and literally catch that wave.
Yeah. I think it's a wonderful time to be a landlord, Rich. I mean, vacancy, apart from inner Sydney and inner Melbourne, which are the exceptions, across Australia, vacancies are, in many cases, the lowest they've ever been. Below 1% is common. A huge upward pressure on rents. Queues of people at every open house for an available rental right across the country. So, it's a very, very opportune time to be an investment property owner.
That's it. All right, well, let's have a look after trends, how to approach this market. And thank you for those writing your questions. We will get to all of those questions, so please keep them coming as we go through. How should buyers approach the market? Do you put on blinkers, or do you do the ostrich, stick your head in the sand? What should you do? Well, here's a couple of my tips going forward. Firstly is you've got to understand what drives local markets. We've got to understand and appreciate, hey, we are in a booming market. You can't ignore that. Some people say, I'm just going to sit out till it cools down. Well, effectively what happens though, if you do that, is sure, you'll get a bit of peace and quiet, but if you were going to spend $500,000 on a property and it rises 10% in that time, you've now got to pay $550,000 for that same property. So you will pay the price of delay effectively. The other way, obviously, to approach the market is make sure you've got your finance in place. No point going and making offers unless you've spoken to your broker. If you don't have a good broker, let us know. We can refer you to some excellent brokers who are available. The other thing is to research. So, and Terry, you provide some fantastic research reports that we use extensively. You've got to understand, firstly, before you even choose an area, what's your goal? What kind of investment strategy are you going to go for? Because your strategy then determines the area and the location and the price points that you look for. So are you looking for just a standalone home or an apartment in a good quality area? Do you want to get a dual income and do a house and a granny flat? Do you want to do a duplex? Do you want to do a small development? Do you want to buy a renovation property? So all of those factors will determine what location you buy in. Also, in terms of yield versus capital growth is another really key factor. So buying in areas that have high yields will give you higher cash flow, obviously, but also just look at what the history of capital growth and projected capital growth will be of those local areas. So what I'm saying here to everyone today is you've got to think long term. Don't just think about buying an investment property, tick it off the list. Every property you buy has got to get you closer to your wealth goal of retirement and looking after you. And Terry, you love my last point there. Don't let media articles sway you. I know you have a good poke at the media from time to time with headlines, but how would you say buyers should approach this market at the current moment?
Look, I think now more than ever before, it's very important for buyers to have a team. It's always the case. We always say to people, build your team before you build your portfolio. It's very important to have a team of experts in various fields and be willing to not only consult them, but willing to actually spend some money on them before you spend the big money. And I think a key part of the armory for an investor trying to operate in this market right now is a buyer's agent. I often write for Money Magazine, and every so often they ask you to take part in a little thing which is, if you had a spare $10,000, how would you invest it? And most people say, I'll buy BHP shares or whatever. My answer was, I'd invest it in a buyer's agent to find my next investment property, because I think that would be a wonderful way to invest a lazy $10,000. It's really important to have professionals on your team at the moment. But also, I reiterate what you say down the bottom, don't let the media articles sway you. I think the situation with property markets is misreported and misrepresented every single day in mainstream media. Just as one example there, the way that they explain the current circumstances with record low interest rates, and that's it. That's the only reason anything's happening at the moment, which is ludicrous. I often say to people, if you want to be successful, stop reading newspapers, just tune out all that static and white noise and talk to the experts. Establish a team, get all your ducks in line. You've got to be ready to move quickly in this market. You need to know what your borrowing capacity is. You need to have that sorted, but you need to be ready to move quickly but sensibly. And you need professional help to do that at the moment.
Yeah. I think 2 words you just used there: quickly and sensibly. I am seeing a lot of aggressive buying behaviour, and it's not necessarily sensible. I just tried to put in an offer the other day on a property, and the agent agreed to do a best and final, and I put in what I thought was a really good offer, and then another buyer came in 220,000 over the top of me.
Yeah.
And I just went, that's just ridiculous. That buyer has just blown a stack of money they didn't need to. The vendor didn't, would have been happy to put another 5 or 10 grand, but instead they got an extra, 220,000. So there's a bit of crazy buyer behavior going on there, and a bit of FOMO going on.
I think the biggest risk for investors right now is particularly those in, say, Sydney and Melbourne, thinking that they're buying getting a bargain, because the big trend is people in the big cities looking to the smaller cities or the regions in particular, and they'll look at property prices in somewhere like Orange in New South Wales, or perhaps Bendigo in Victoria, Toowoomba in Queensland, and think, oh, that's cheap. But it's not necessarily cheap. It may be above market value, and if they're making a silly offer to secure it, they're going to be paying above market value. They're paying too much, but thinking they're getting a bargain because it's cheap compared to where they're sitting, which might be Sydney. And that's a huge risk at the moment.
Well, it's all about comparable sales. You don't compare a 2-bedroom unit in Darwin, to a 1-bedroom unit in Potts Point. They're very, very different markets. And I think you're absolutely right, Terry, about comparing like with like. So, all right, let's move forward. What I'll do now, Terry, is just do a quick overview on sort of, I guess, what we can do as buyers agents. I'll only spend 2 minutes on this, and then look at some case studies, and I want to throw it open to Q&A. So whether you use a buyer's agent or whether you do it yourself, you should really essentially go through these 7 steps as a buyer. A lot of people just jump online to realestateanddomain.com and start looking for a property. They might have a figure in their head and say, look, I've got 600 to spend. Let me see what I can get for my money, rather than thinking about a strategy. So what we like to do is sit down with our clients, have a strategy discussion, and then from that, all your goals, objectives are worked out to work out what is going to be best for your long-term objectives. Once we do that, we then give our clients some research, and we look at the local area, we look at suburb profiles, we look at median prices, predictions on where things are at, current yields, and that way you've got a benchmark as to what your money can afford you. Then the 3rd step is actually doing the searching. So a lot of people jump straight to step 3 without doing steps 1 and 2. And the searching is obviously a very mechanical process, very time-consuming process, looking through multiple listings every day, screening the internet, calling agents to get a short list of suitable properties. Now, we get access, Terry, to a lot of off-market properties. What you see at the internet is a tip of the iceberg as far as a buyer's agent is concerned. I'm astounded by just how many opportunities we get on a daily basis for our clients. And especially during COVID, we probably did more than 50% of our transactions in our off-market space. So that's a huge value add to our client base.
That's one of the ways to cut through the current circumstances, of course. Having access to that is a huge advantage in a market where properties are selling so quickly.
Oh, it was just crazy. I mean, whether you're a home buyer investor, and if you can eliminate the competition and just pay fair market value and then watch it rise, it's a dream. Once we've found that ideal property, or we think the one that ticks the boxes for you, then we appraise the value. We give a written report on what we think is the current market value, and that's a very important piece of information. And then steps 5 and 6, completing due diligence, getting the pest and building report, checking any neighbouring DAs, checking other bits of information, and then negotiating. And this is where we take a lot of the emotion out of the process for our clients, simply negotiating well and advising them objectively with facts on market value. The other step is just moving quickly to exchange. A lot of buyers are going to miss out this year because they're too slow, their solicitor's too slow. So you do need to move with a relative level of efficiency to get a deal done this year. And then the last step, if you're an investor, is obviously get a property manager, which we can recommend, and attend to the pre-settlement inspection. So we do all of those steps. I guess the key benefits, as I mentioned, is just helping you do a strategy off market. And I guess the other key thing, we just bring a level of confidence to the whole transaction that people wouldn't otherwise have. A lot of people are second guessing, reading one report only or one tidbit out of a magazine. So we dig a lot deeper for our clients in that regard. So that's, I guess, the key benefits. What does it cost? A quick little plug, but basically we work on a fixed fee basis. So for any property under 500K, we charge 11,900 including GST, and that's a capital cost, so it's tax deductible. And then we have a sliding set of scales. So roughly about 2% up until $1 million, and then a sliding scale down from there. But if anyone is interested in our service, very happy to help you. Just send an email to us and we'll send you some information as well. So Terry, I'd love to go through some case studies. This will take about 5 minutes, and then we'll go to Q&A. So these are some recent sales that we've done for our clients. This one was done just in the last 2 weeks in Brisbane. The property was only 5 years old. It looks like an ordinary house from the front, but it's a dual living property. It's got a 3-bed and a 2-bed accommodation under the one roof. Now, it was on the market for 520. We appraised it at 520, but actually it was remarkably got it at a discount in this market because we found a motivated vendor. So it rents for $630 per week, so it gives us 6.7% yield. So any Sydney buyer, that's a dream come true. So I'd be very happy to have any of those kind of properties in my portfolio. Another one we did in the eastern suburbs. This was a recent one, again, a home buyer. There's a bit of a two-speed market going on in the Sydney market. Now, apartments aren't completely down in the dumps. They're just not as in crazy demand as the housing market is. But again, moving fairly quickly, we managed successfully to buy this one at auction. Agent guides, as we all know, are pretty much underquoted at the moment, but our doctor client was extremely happy with the result. This was another one we bought in Newcastle. This was a house that had been converted into 3 flats. So for an investor, it'd just be a great buy and hold. You can still just keep renting it out, or if you're an owner-occupier, you could reconvert it back into a large home. But amazingly, we're able to get a yield of just over 7% on that one. So it just shows especially a strong regional area like Newcastle, to get that sort of yield is just fantastic. This was one we've done in Western Sydney. We've done a lot of these over the years, and they're still a good strategy. So buying a house and then adding a granny flat. The challenge now is trying to get houses under the 700 mark. A lot of them are going up to 750, but still a worthwhile scenario. So buying an existing house, you're probably going to get maybe close to a 4% yield if you're lucky. But then adding a granny flat, you'll get 5.5%, possibly up to a high 5% yield adding a granny flat. So we think that's a great strategy. You get some good benefit coming off the Western Sydney Airport, but areas like Oxley Park, St Mary's, where the new metro train station is, out toward Penrith, areas that we think will perform quite well. Another one we've done just recently, beginning of this year, we had a high value client looking to buy blocks of units. So this particular investor bought this block of units just near Merriweather Beach, where the surfing competition is going to be happening in a couple of weeks, when all those surfers flying in from overseas will be attending. But this was a really good opportunity, great buy and hold. We got this one just under our appraisal, and a 4% gross yield on this one. So really, really good position. So that's a great buy. If you can afford that sort of thing, a really good buy. Another one we've done in Brisbane. This was a house where we could add both a granny flat and do some renovation. A lot of the high set or double story homes in Brisbane, often the height limit of the ground floor is not habitable, but this one was large enough where you could actually split it. So you could potentially even get 3 incomes out of this one. You could rent the downstairs, the upstairs, and add a granny flat. But as it is, the client's just going to hold it and add a granny flat later on. But even as is, it's delivering a 6% yield. So a great result. And then I think this is the last one. We just bought this for a client last week, again in Western Sydney. Now, again, our connection with the local agent was the key here. We were able to buy this property. We were the first one to view it. You can see in the picture next door, there's a nice big block of townhouses going up next door. So we had a client that wanted to buy a site where they could do 4 to 5 townhouses. We got this for $950,000. Sewer lines in the right position. It's an R3 or medium density area, over 1,000 square metre block of land. So fantastic opportunity. So even in this market, getting something slightly below value is possible if you've got the right connections. And moving quickly for our client was what achieved that for our client. All right. Well, that's enough of the case studies. Terry, any comments on those, or should we move straight to Q&A?
I mean, one of the standout of your case studies was buying in capital cities, well-located property with rental yields of 6 or 7%. I mean, that's good investing, and it's indicative of what you can achieve if you go about it in the right way, if you follow the step-by-step process that you outlined earlier in the presentation, and have a good, strong team around you, including a good buyer's agent.
Perfect. Well, look, my details are on the screen. If you want to get in touch, and we will be sending out a link as a recording to this webinar. But I might just stop sharing my screen. Stop share. How do I do that? That one. And there we are. And Terry might just hit some of the Q&A. So if you want to kick it off, and then I'll come in as well.
Well, probably the first question that came in earlier from Margaret is probably a pertinent one to launch into this phase of the webinar. Margaret asked, how long do you think this boom will last? What factors will bring it into a more normal market? I think that's the question that's been asked a lot in media and elsewhere. You know, does this thing have legs? Is it a flash in the pan? How long will it go? And that's a pertinent question for those who think, well, I'll just wait this out. I'll wait till it settles down, then I'll buy. Personally, I think this is the first national boom that we've had in Australia for 20 years, and it's got longevity. What do you think, Rich?
Look, I think this boom definitely has long legs. I mean, the government's injected over $200 billion of stimulus, and that's found its way into households' pockets, into businesses' pockets. It's restored confidence for both consumers and business. So obviously we've had some pretty negative times with the lockdowns and with the health impacts of COVID, but we've bounced back. We're a resilient economy, we're resilient people. So I think this boom is going to last. People in Australia love bricks and mortar. And I think the drivers for this boom is obviously, number one, low interest rates. Interest rates, like the long-term bond yield curve, has actually just started to trend up a couple of basis points. So even though Reserve Bank has said, look, interest rates are on hold for 3 years, just watch this space in that third year, just depending on how our GDP numbers go. We still have a big overhead of debt to pay back, but Australia's in a great position. We're going to see a commodities boom, we're going to see an education boom, and we're going to see a property boom in the next 3 years or next 5 years. So all of those factors. Again, if you look at somewhere like New Zealand and look at the quality of their environment, and there's a long list of people that want to get into New Zealand and Australia. So I think when the migration opens up again, watch this space. So I think our boom is going to be a long boom. It's not a short-term fizz. It's very much a long-term boom underpinned by strong economic fundamentals.
Yeah. And the infrastructure-led economic recovery, although we're already recovering pretty strongly based on today's GDP numbers, but it's going to give extra impetus to us. And we already have a resources boom, but I think it's going to get stronger because of the infrastructure spend. We're building lots of new motorways, rail lines, universities, hospitals. The demand that will create for resources will just give even greater strength to the resources boom that's coming. Bill is commenting, Rich, that I think it's fair to say the boom we're seeing, at least in Sydney, is more freestanding houses. When do you think the unit markets in the big cities are going to bounce back?
Yeah, I think there's a bit of supply issues in certain pockets of Sydney. So places like Parramatta or Burwood, Ashfield, around Homebush Bay, there's been a bit of obviously negative press around apartments, Opal Towers, Mascot Towers, those kind of issues. But I think long term, in the apartment market, in the right locations, will perform well. So if you are in the apartment to buy, in the market to buy an apartment, pick an area that's close to a train station, close to good parks, local amenities, got the right connections, and something needs to be unique about that apartment. Either a larger internal floor plan, a third bedroom, big balcony. Don't just buy a run-of-the-mill squishy 2-bedroom unit that's 55 square meters. Right? Make sure you buy an apartment that's a high-quality apartment, high-quality build, and it's got some sort of unique factor about it.
Yeah. very important. I mean, so many apartments are just very generic. They're replicated by 200 others in the same building. So you are looking for something that's got some level of uniqueness about it. And David's asking a question a little bit mischievously, but it's probably a good one to pose. So now the banks are all predicting rising prices and nearly always get it wrong. Should we be worried?
No, I love that question, Dave. I know. No, Dave, don't get worried. I love it. So.
Well, I mean, he's right, David. The banks, I mean, 12 months ago, they were all predicting a collapse in property prices, and around about September, they all went public to admit that they got that horribly wrong and started to predict something a little bit more bullish, and they've become increasingly bullish. Interesting that the banks, they make a forecast for the next 12 months, and then 2 months later, they change their forecast, thereby raising the question, how much value do their forecasts really have? What's significant to me, David, is not so much what the economists are predicting. It's what the specialist, experienced, credible property analysts are saying. And there's plenty of those out there, like Simon Presley of Propertyology, Louis Christo, SQM Research, and we certainly take a lot more notice of their forecasts, and they are suggesting that we're in the midst of a national boom that's going to extend through this year and well into next year.
Yeah. I like the question about land. I like the question about land taxes, Terry. Are you concerned about increases in land taxes? It has an enormous difference on net yields. Absolutely. Look, I think land tax is an interesting one. In New South Wales, there is a proposal to replace stamp duty with an annual land tax. So you have a choice of either paying upfront stamp duty as it stands or paying an annualised tax. Now, to do the basically cost-benefit analysis on that, it basically, if you're going to hold the property for longer than around 15 years, then it basically works out better to pay it up front. If not, then you're better off to just pay the annual land tax. I don't think land taxes are going to go through the roof. Like in New South Wales, it's 1.6%. I forget the number in Brisbane or in Queensland, but it's not going to go from 1.6 to 2% overnight. It's very, very likely to stay at fairly low levels for the life of land tax. What are your thoughts, Terry?
Well, I always think that one of the ways to mitigate against land tax is to have a geographical spread in your property portfolio. I'm still encountering people almost daily who they're in Sydney and they want to buy more in Sydney or in New South Wales and are resistant to the concept of perhaps looking interstate, spread their portfolio around the country. There's all sorts of reasons for doing that. Having a geographical diversity in your property portfolio mitigates against all sorts of risks, but also against land tax. Now, Stephen's asking a fairly pertinent question, which I'd like to address. He's asking what's the expectation post-COVID when the borders are open and international travel resumes? Will the draw to regional slow or reverse? I know what I think. What do you think, Rich? So
the question is, sorry, just repeat it again. What will happen in the regional areas?
I think what Stephen's referring to is media has tended to characterise what I call the exodus to affordable lifestyle, people moving to the regions of the
Will it come back? You're basically asking, will it come back?
Yeah. Well, it's been represented as a response to COVID, and what I know to be true, it's been underway for a lot longer than that. So, the inference is that once COVID's dealt with, then this trend to the regions will stop or reverse.
I don't think it's going to reverse completely. I think what we're seeing is an acceleration, as you've talked about, Terry, as the exodus to lifestyle. There's very much so. But I do think the intensity with which people are migrating to the regions will slow. The impetus to run to the hills or to go to the regions and the tree change and the sea change has always been there. People love the big, great outdoors, or they love being close to the beach. So that impetus has always been there, but COVID has accelerated that trend. But I think that trend will, as I say, the volume or the intensity of that trend will start to slow, in my view, in probably 2-3 years. It's also going to depend on how businesses react and manage their workforce. I think a big factor is with the big corporates, how much of their work can be done logistically remotely. And if that sort of problem is resolved more permanently, then you will see more people being able to trend out to the regions. So that's my thoughts on it.
I think it's very much about technology. It's not so much about COVID, and more and more people realising they can work remotely and therefore can access a different lifestyle. I suppose one of the big attractions is you can sell in the big city and move elsewhere, perhaps to the regions, buy something of comparable quality but at half the price and have money left over. That's a big attraction. I think it's a trend. Sydney's been losing a population to internal migration for 10 years, and Melbourne for the last 3 to 4 years. So it's been underway for a while. It's not been driven by the pandemic primarily, although, as you say, Rich, it's been certainly accelerated by 2020. Now, Melissa is asking, the fact that we have so much land that could be released and developed makes this housing situation a disgrace. Poor planning by governments past and present. Well, I totally agree with that. I think, we have a shortage crisis at the moment. It's showing up in the rental figures, and the fact that so many people are struggling to find somewhere to live as tenants. Governments are so focused on things like COVID-19 that they don't even seem to be aware that we have this rental shortage crisis across the country, and some action is required. They need to be actually encouraging people to get out there as property investors and buy and make properties available for rental, as opposed to what Labor presented at the last federal election, which was a huge disincentive to investors. And thank God that didn't come to pass, because the situation will be even worse than it is.
Well, Terry, my soapbox, quick 30-second soapbox, is we need more medium density. I talk to so many agents, and a lot of people won't move out of their homes because they can't move into anything in the local area that's small enough or good enough. So we need more manor housing, town housing in low density areas. We don't want high density, but we need slightly more medium density, where people can age, go to that townhouse, go to that villa before they move to a retirement village. And there's a lack of housing. And so there needs to be accelerated planning, smart planning around that medium density done sensitively.
Okay, so here's a question from Remy, which would speak nicely to the sorts of things that you would do with clients. Rich is saying, I'm in the middle of selling my house to be able to upgrade. Is it now better to sell first and buy afterwards, or the other way around? A perennial question.
Perennial question, and the answer changes, a bit like the answer for economics, it changes every year. The answer to the question at the moment, it depends on the suburb. I would say generally you're better to sell first and then buy. That's always the safest way. However, you don't want to be priced out of the market. So if you know that if you've had 3 agents come around and value your home and they've given you an estimated range and you feel comfortable, in this booming market, that's the only time I make an exception to that rule, where you can buy before you sell, because you don't want to be stuck with nowhere to go. So yeah, that's my answer.
Yeah. Knowledge is asking, a lot of the questions that come in are often questions where my response is, well, there's no one right answer. It depends on the individual. So Knowledge is asking, are house and land options good for investment?
No. Sorry, a bit of a blunt answer. Generally, no, right? There's too much fat paid to the developer and the builder in the deal. It's a bit like buying a brand new car, driving out of the showroom. It's going to depreciate quickly. In probably 98% of what we buy for our clients is established properties, and we find they're much better value. They're often better located than the traditional house and land package that's sold to you by a property spruiker getting 30 or 40 grand commissions. So my view is look very, very carefully at the detail of what you're buying if you are considering that, and then take a cold shower.
Okay, Sihan is perhaps making a comment that you might have something to say about Rich Agents have stopped quoting price guides online or at open houses in Sydney. They're pressing prospective buyers to come up with a value. Sounds like a good reason to have a good buyer's agent on your team.
Well, I think it sounds like the agents have given up, Terry. I don't know the agents. I don't know the price. Just let the buyer do the work, And a lot of agents are struggling, right? But we all know that there are underquoting laws. But in a booming market, it is very difficult to put a value on it. It's going to depend how many buyers are chasing it. Like there was another property I saw the other day that had 35 contracts out on it. And it went for about 500 grand over what I estimated was good market value. So price guides are at the moment, unfortunately, quite misleading, and they certainly attract bees around the honeypot. So it is just a very difficult market. So you've got to look at sales, the most recent weekly sales, to get some sort of picture as to where you need to be to actually secure a property.
Just a general comment to people, if you are typing in your questions, please try to make them really succinct and clear, because if they're extremely long-winded, it's very difficult to absorb all those information. And if there's 4 questions in the space of one paragraph, it's a little bit difficult for us to handle. So try and keep them short, snappy, and concise. Kevin's asking, are recent regional investments leading to better yields with rental returns by investment buyers?
Regional areas, yeah. Look, I mean, generally the regional areas are very, very low vacancy rates. I've seen some in Newcastle, like 1% vacancy rate. So yeah, that's definitely leading the charge. But again, whatever regional area you're considering buying, make sure it's got all those long-term economic drivers. I'm not advising to buy in places like Karratha or Port Hedland or Mount Isa, where there's a very limited pool of economic drivers. So just be very careful when you do go to the regions that it's a more major region with lots of drivers.
Yeah, I think economic diversity is absolutely crucial when you're buying or anywhere, but particularly in the regions. You want a regional centre of some substance, but with economic diversity, certainly not mining towns. And also be wary also of locations where just purely about tourism. You're wanting something with a little bit more diversity and strength than that. Adam's just following up on that, asking, is it a good idea to buy what he describes as outer regional areas like Cessnock or Maitland, that's the Hunter Valley, or Tamworth, where the price entry is much lower?
I'd still go, if I was comparing Cessnock, Maitland to Tamworth, I would go Cessnock, Maitland, because you've got access to the Hunter Valley and access to Newcastle. Look, Tamworth's a great city, but I just think there's probably more drivers around the Hunter, Newcastle region than there would be in Tamworth, which is more agricultural focused.
And if you're buying in a place like Cessnock or Maitland, you are part of the Hunter region, but you're also very closely connected to Newcastle, which is actually one of Australia's biggest cities. It's bigger than, I think, 3 of our state and territory capital cities. And it's a substantial economy with a huge future. So an investment in those kind of places is also an investment indirectly, I think, in the Newcastle economy and the jobs that are available there. Okay, AJ is asking, if you were a first-time investor looking at a higher rental return and long-term growth, can you pick a suburb with a purchase for a median of around 300,000? Well, you certainly can, and particularly in some of the smaller capital cities, I think, Rich. I know you're very active in the Brisbane market, for example.
Yep. I was just going to say Brisbane out toward the suburbs, out toward, if it's only 300k, it's going to need to be up toward Ipswich. And if you can buy something that's got extra, like a decent land size, where at some point in the not too distant future you can add a granny flat, you're going to do quite well.
Yeah. Okay, and I'm looking at buying land, property to develop into affordable townhouses in regional areas to create active growth, like Cessnock's mate. I think following on from an earlier question. Okay. It's more of a statement than a question, but do you get many clients, Rich, that are sort of not just passive investors? They want to do a little bit more, including small developments?
Absolutely, yeah. We have a whole development division within Propertybuyer, and we can help clients do as small as just a simple duplex to land subdivisions, and then we help also large-scale developers buy large tracts of land. And we also help other developers find boutique apartment sites. So we can definitely help clients with any of those strategies. I guess the key thing is just, you've always got to look at your exit strategy, whether you're an investor or whether you're a developer. If you're a developer building 4 townhouses, you've got to look at where the market cycle is at. Because if it's going to take you 2 years to build the thing and get it out of the ground, you've got to consider, what is my end price going to be in 2 years' time? Very hard to predict. Some developers got scared during COVID and didn't buy. The really smart developers tried to acquire as many sites as possible because they knew we'd come out of the gates running.
Now, Louis, putting us a little bit on the spot, what are your top 3 regional areas of New South Wales that you'd recommend for growth and yield, and why these areas?
Is that one for me, or do you want me to answer it? Okay, well, top 3.
I can have a crack at it if you like.
You go first, and then I'll see if I agree with you. You go.
Yeah, look, for a nice blend of yield and growth, again, we're looking for regional centres with a certain size, diversity in the economy, good proximity to important things. I like Orange a lot, and not so far west of Sydney. I think it's got ticks all the boxes. It's a nice blend, but I think medium prices in the 400,000s, pretty good rental yields available there. Albury-Wodonga at the border is a fantastic regional city. The only problem there is it's so popular and so competitive. It's become very, very difficult for people to buy safely and sensibly there. But it's, I think, taking a long-term view, I think it's a great performer. Good rental yields, still affordable despite the recent price rises. I like actually Queanbeyan, just outside of Canberra. It's part of New South Wales, but it's really effectively part of the Canberra metropolitan area. It's got advantages from having a foot in both camps. It's more affordable than Canberra, so a lot of people can go and buy there, but it's only 15 minutes drive from Parliament House. If you want to go there, hopefully not. Very low vacancies, and it's sort of benefiting from the steadiness, the consistency that with which Canberra always performs.
Cool. Well, Yanni, to add to that, I always strongly big believer in Newcastle. I think that market is just fantastic, great lifestyle. It's got some really attractive suburbs, and also down towards Lake Macquarie. There's some really attractive waterways around that way, and I think a lot of Sydneyites have discovered a great living atmosphere there. Also, there's parts of the Central Coast I think are quite reasonable too, and I think a lot of first home buyers are discovering they can still be within cooey of their parents, but have their own lifestyle, not too far out of the city. So that'd be my two.
Cherry is asking a question I know you already touched on. What are your thoughts on mining towns? Will they be part of this national boom, or would you steer clear? I think the answer from both would be steer clear, always and forever.
Yep. Simple.
If you're a genius and you time your entry and your exit, maybe, but nobody can do that. No one's ever succeeded. I know people who have bought in the previous sort of mining boom and ended up with multiple properties worth less than half of what they paid. It's just not worth it. There are so many good places to buy that can serve you as an investor long term that you just don't need to take those kind of risks. Lauren's asking, has the level of foreign investment in property increased or decreased? Is expected Australia will experience an impact from suffering economies due to COVID, such as the UK being in lockdown for an extended period? Foreign investors, Rich, is that much part of your business?
Look, we do. We've helped a number of foreign investors buy. Obviously, the FIRB charge an arm and a leg now, so you're paying virtually 8% stamp duty, and you've got to do that FIRB application with no guarantee of being able to buy the property. So obviously the volume's dropped way down, and I think it will continue to be there. But once the borders reopen, I think a lot of the high net worth kind of buyers will start to look to re-enter to buy more prestige property. But they're not a big factor impacting the local market at the moment.
Yeah. Paul, the government has been encouraging lenders to relax criteria. Is this really happening? A year ago, my broker told me the lending panel would not refinance my facilities due to tightened criteria. Should I retest the waters now? I know that's not really your territory, but you'd be aware of it because your clients need to know about things like
Absolutely. Well, Dave Hawes is on the line, and he's a great mortgage broker and just talk to a good broker. Again, we can recommend you to him. But if you, in terms of financing, I always recommend to be ready to buy. So always get your broker to look at your numbers, make sure you're not paying too much interest, and don't be afraid to refinance and look at what the criteria is, because the criteria, I'm talking about property prices, bank criteria changes daily as well, and there's no way you can keep up with all the products. So highly recommend using a good mortgage broker, absolutely essential person to have on your team.
Yeah. I think David's asking a question that was probably the central theme of the whole presentation today. How do we achieve the balance of buying quickly and sensibly?
Great question. Well, I think, like I said in my presentation, you've got to know, firstly, what your criteria is. So if you're a home buyer, it'll be 4-bed, 2-bath, 2-car, quiet street, certain size rooms. When you find that property, you will have a sense whether you can live there, right? Now, the word, that's sort of quickly. So it's having your finance approved and having your solicitor ready and your pest and building done. So they're all basic building blocks. But then how do you beat the other buyers? Now, that's a challenge. I mean, we have a number of tactics we use. I won't spill all my secret sauce on this webinar because that's my job. But you've got to move certainly quickly, but know what the most recent and relevant comparable sales are. So if you're not tracking the auction results on a weekly basis, you must be. If you're not tracking all the private treaty sales, you have to track them. So you have to ring up like a lot of agents will put sold, but they put contact agent. It won't actually have the sale price. You physically have to ring up the agent and say, what did it sell for? You need to write that down. So you're going to have new benchmarks every week on where the prices are. So look, buying a property is a really time-consuming process, and that's why we exist, because we do that for our clients. But once you know where the prices are, and you can move on something and you feel it's in the range, go for it. Why hold back? But you're not going to spend $500,000 more on a property that you need to pay. That's for sure.
Yeah. Arthur's asking, are there any good suburbs offering value on the Sydney North Shore at the moment?
Suburbs on the Sydney North Shore, was it?
Yeah.
Oh, well, that's a very broad. Is the upper or lower? So, I mean, I haven't seen the question. Does he say upper or lower North Shore?
Both, I think, north and south.
Well, it's a very broad area. It goes from Hornsby right through to Waverton and North Sydney. So, look, it's probably a too broad a question to answer. I mean, there's some what I consider good value pockets. I mean, places like Linfield, Killara, they've all got median prices approaching high 2 millions now. If you go closer up the railway line to Wahroonga at the W's, Warrawee, all of those are still always high value suburbs because of the schools in those areas. I think if you get a little bit away from the train line, you'll always find it on the western side of the highway is cheaper. The eastern side is always more expensive. So like South Turramurra, South Turramurra, South Wahroonga, over toward Normanhurst, those areas will be cheaper. So there are pockets, but they're going to be further from the train networks. That's all.
Yeah, I often think that the questions that people ask, very much the answer depends on their circumstances, and therefore the requirement is for an analysis of their situation before you can actually answer a question. That's why I think people need to build their team before they build their portfolio. Then you need to have experts around you that you can go to and analyse your situation, make a plan, develop a strategy for achieving the plan. Good buyer's agent certainly helps. Lots of questions about different locations. Vipin is asking our views on investing in Ballarat. Andy's asking, do we think Bendigo is a strong market to invest in? A couple of locations, important cities in Victoria. Do you sort of delve into those markets much?
Yeah, look, we do look at those areas, Terry. I guess if I was looking at Bendigo, Ballarat versus the other outskirts of Melbourne, I would still go more the outskirts of Melbourne. So whether you're looking in places like Melton or down toward Frankston, I would tend to buy in those areas first than I would be buying in, unless your goal is purely cash flow. So again, it just comes back to what is the strategy. So that's why I say, Terry, like, people want to say, what's the best area to invest? And I can provide a number of answers to that question. So, I mean, our buyer's agent on the ground, depending on the person's budget, will be able to pinpoint exactly whether it's Frankston or whether it's Mayfield or wherever it's going to be for that client.
Remy's asking, do you guys see any negative effects on the housing market after the coming changes to JobKeeper?
Yeah, right, we didn't answer this. That's a good question. So let's answer that one, Terry. We promised to answer that. My view of JobKeeper finishing is that it will cause some economic pain for people, particularly in hospitality and travel and tourism related industries. So it's been a lifesaver for a lot of cafes and a lot of businesses. When it finishes, yes, it will have some impact. But overall on the property market, I think it will be a blip on the horizon. So I think there's such strength in the property market that the JobKeeper finishing, you're not going to see hundreds of desperado sellers suddenly hit the market. As much as anyone wants that, that's what I think is going to occur. So for me, it's a very minimal impact on the property market. What's your take, Terry?
Well, I go back to my list of reasons why we're in this property boom in the first place, and there are 16 very clear different items on that list. Now, government stimulus is just one of them. JobKeeper is just one small element of government stimulus. So you remove part of one of those 16 items from the equation, you still have a very, very strong situation. You know, this market has not been caused by JobKeeper. It's just one of multiple factors. And we would need the removal of many of those factors before it would diffuse the current situation. I think I've got a similar view about interest rates. I don't think the impact of interest rates is as strong as many people believe. But if interest rates do start to rise, and the Reserve Bank has indicated they're not going to any time in the next couple of years, but if they did, for other reasons, it wouldn't necessarily diffuse real estate boom. In the 1980s, they kept putting up interest rates and the boom just raged on. Interest rates went to 18%. In the early part of this century, the last time we had a national property boom, interest rates were sort of 7 or 8%, and the Reserve Bank kept raising interest rates and the boom kept going on. Increases in interest rates aren't necessarily going to dampen things down. Even if they occur, which appears to be unlikely at this stage.
That's right. I think there's a good question we'll just hit with David. There's asked about APRA potentially interfering with the market, and will APRA tighten the availability of credit given where the boom's going? I think APRA will keep a very close eye on the market, but the last thing that APRA would want to do is curtail a recovery in the economy. Interest rates are low because the government wants to stimulate spending and investment. The minute you start raising interest rates, it's like tapping the brakes. So I don't think APRA will probably intervene unless we sort of see, more than a 30% rise in 1 year. Now, yes, property prices did go up 2.5% in Sydney, but they won't continue at that rate per month for the next 12 months. There'll be a pause. I'm seeing that a lot of people going to brokers are getting a budget or a borrowing capacity, and then they're happy to go straight to that top of their range. And that's what's causing a bit of this boom at the moment, is people just borrowing as much as they can and then spending as much as they can. So you do need to factor in at some point interest rate rises, but I don't think those interest rate rises will be dramatic either, Terry. They'll be gradual and small. We won't be going up in 1% and 2%, so it'll be 0.25% rises over a period of time, and that will certainly dampen the market. But low interest rate environment, we're here for the next few decades.
Yeah. And as I said earlier, even if interest rates do start to rise at some point, they're not necessarily going to dampen down a boom, which is happening for a whole host of other reasons. Well, Rich, we've actually been going for an hour and almost 10 minutes. We've only dealt with a fraction of the questions. We could probably sit here for another 2 or 3 hours if we're going to deal with all of them. I've never seen so many questions come in. It's obviously a topic that's very topical.
And they're great questions too, Terry. I'm sorry we don't have more time, but I obviously wanted to say I really appreciate everyone participating today, and thank you. And I'd love to get in touch with anyone that would need a hand or would like some questions answered. Feel free to give me a call. And we will create a webinar link for this, won't we, Terry, and send that around.
That's right. We always send a recording to everyone who's registered for it. So people who weren't able to participate live will get a recording and can listen to it at their leisure. And those that have been able to watch live but like to watch it again, maybe, we'll also get a recording of it. So we haven't been able to answer all the questions, maybe not even half of them, but please feel free to follow up with Rich, and he's given you the contact details. You're also welcome to contact me, ryder@hotspotting.com.au, if you've got some comments or some follow-up questions. But I think today's webinar, the numbers that have attended, and yes, there you go on the screen. Please follow up and contact Rich if you have a need for a buyer's agent or just have some questions. I would like to perhaps analyse your situation and get some guidance on the best way forward for you. And I think that's really important. Rich did have a slide which showed that there's some steps that you need to go through. Too many people get excited or get pumped up by the FOMO syndrome and realise there's a boom on and want to just dive in and buy something. If you go about it that way, you may not get the result that you're hoping for. So please talk to professionals like Rich and have a discussion about your situation. I think that's the most important message we can leave people with today from today's event, Rich.
That's it. Excellent. Well, look, I just want to say thank you, Terry. Really appreciate your hosting. Thank you, everyone, for participating, and certainly look forward to reconnecting again with everyone very soon.
Okay, thank you again, Rich. You're always the most popular of our webinars. We always get, for some reason, bigger numbers than any other. So thanks for your participation and for letting everybody get the benefit of your knowledge and wisdom.
Pleasure.
Thanks everyone for participating. Well, let's do it again soon. Bye for now.
Thank you.